Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures page on the screen now. These can also be found in the description on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both the positive and negative news across our activist holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress on our activist strategy in creating new metal deposits in viable mining jurisdictions around the world. If you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about our investment strategies, we encourage you to reach out to Merrick Iwahashi. His contact information is on the screen now and can be found on our website at crescat.net. So let's get started. All right. There are three important supporting themes that drive our conviction on the timing for investing in gold, silver, copper, and other metal exploration stocks. Right now, we think the timing has never been more compelling. In our analysis, the first one is it's the unsustainable debt and government deficits in developed economies that make inflationary pressures intractable and fiat currencies more susceptible to debasement than they've been since the 1970s. We believe, number two, that there are critical metal supply constraints under rising demand given U.S. government spending initiatives geared towards commodity-hungry infrastructure projects, reshoring of the manufacturing supply chain, and green energy projects. So these supply-demand imbalances are critical right now. And number three, there's an opportunity to generate significant alpha and beta, we think, to outperform metal prices in this likely coming bull market through an activist exploration strategy where our companies seek to make economic discoveries and build resources through carefully constructed drill programs in viable mining jurisdictions around the world. Now, this chart here shows recently gold has broken out to new all-time highs, but the exploration index, which is really the TSXV composite, comprised of about 51% exploration-focused mining companies. It has about 7x performance to get back to its prior all-time high back in 2007. Okay, look, metals exploration investing is risky, and picking the right companies within this huge universe of opportunities. There are 3,600 publicly traded mining and metal stocks globally. It's a huge opportunity set, and picking the right stocks within them is really critical because most of these companies, they have mining claims and a dream of a big deposit, but that's really about it. And really having an expert like Quentin with his 40 years of industry experience in exploration on our team here at Crescat, that is what's critical to being able to make the right kind of stock selection, we believe, and having a professionally managed strategy, we think is key. But look at the lag in mining stock performance already relative to gold. We are excited about how much opportunity there is to catch up, and we believe that's all ahead of us here in the coming bull market for metals and mining, for precious metals, for base metals, and that includes copper and zinc and a lot of other things. That is key to the world, to world civilization, and what exploration mining is all about. So let's go on to the next. So this is really looking at the number of drills. So the size of the circle is relative to the number of drills. And among our companies collectively in our portfolio, we expect to have 114 drills turning over the next 12 months around the world. Hopefully we can do even better than that as we get involved in getting even more capital to our companies. But that's the target right now. And this is more greenfield exploration drilling, really than all the gold mining majors combined. And that includes, Barrick and Newmont and Agnico Eagle. It is, that the majors have abdicated exploration really to the juniors, and they do some exploration on their own. But the opportunity, we believe, is that there is an M&A cycle coming because the majors have underinvested in exploration for so long and in building new mines. They're going to have to come to the juniors if they want to grow their production and help meet demand for the coming bull market cycle that we see. So let's go on to the next. All right, so I'm going to tell a little bit of economic history of gold and of metals. Why? Because we live in a world today where mega cap tech stock investing and the excitement over AI and cryptocurrencies is what has really been dominating in this we think highly speculative world because of all the fiat money printing that has gone on. But we know through studying world history, what fiat money printing and debt and deficits ultimately lead to, and we also know the economic history of all these countries, all these currencies, and of gold and silver as a monetary asset. So let's just consider that. Get to my point on this one. Let's just consider that archaeologists, have found gold flakes in Paleolithic caves that date back 40,000 years. So precious metals have had a rich and enduring world economic history on their side. I actually think it's in the DNA of humans to like gold, and that's the evidence back going 40,000 years. Go on to the next. But in ancient Egypt, around 3100 to 332 BC, it was silver along with agricultural goods that were used as money. And why not gold? Well, because gold was the sacred skin and flesh of gods. Pharaohs, who were considered divine beings, they wore it and they were buried in it. So there's old King Tut's mask right there. Let's go on to the next. Imperial Rome, at least a 500-year reign, was one of the biggest and most enduring world economic powers of all time. Now, as Quentin likes to say, Rome wasn't built in a day. It was financed and built over 5 centuries with gold and silver coins, which the empire used to conduct trade and to pay its armies. Let's keep going here. So here, does anybody know what we're looking at here? This is the first banknote. This is the first paper money. It was invented in China.
Who believe in that?
Invented in China during the Song Dynasty, about 960 to 1279 AD. So the Chinese invented movable type printing centuries before the Gutenberg printing press. Chinese would also invent gunpowder for weapons, the magnetic compass, the mechanical clock, and the pound lock, which was a type of canal lock during this period, the Song Dynasty. Paper money initially was a huge success. But part of the reason for that success is that these banknotes were exchangeable for metal coins. The money was backed by metal. and that was a key element of the prosperity of the Song dynasty. So, fast forward another 100 years or so, and Marco Polo was traveling, a famous Venetian merchant and explorer traveling in China. And in his book, The Travels of Marco Polo, written around 1300, he would describe his astonishment at witnessing the use of paper currency throughout the Yuan dynasty under Kublai Khan. So the Mongol dynasty had overthrown the Song and would go on to suffer from hyperinflation after issuances of excessive amounts of paper currency to fund their wars, and expansionism while depleting all of their silver. Let's fast forward a little bit more here. Let's go on to the next. So Spanish conquistadors in the early 1500s. They were looking for gold. I'm talking about Cortez and Pizarro. And Cortez would conquer the Aztecs in Mexico, and Pizarro would conquer the Incas in Peru. And they were looking for gold, and they found some gold. But what they really found was a mountain of silver in modern-day Bolivia. And Cerro Rico de Potosí was the largest silver discovery in world history. So the Spanish mines in the Americas produced over 150,000 tons of silver between the 16th and 18th centuries, over 80% of the world's supply, making Spain the wealthiest and most powerful nation in the world by the late 1500s. But the discovery of just one giant ore body alone, Cerro Rico de Potosí, or Tavi can pronounce it better than me, I butcher it, in modern day Bolivia, would account for over 37% of the world's silver production from 1545 to 1810. So for over 200 years, 37% of the entire world's silver production was coming from one ore body. Let's keep going. So at the same time as Spain ruled the world through its colonialism, the Ming dynasty in China would rival it in economic power, driven by thriving global trade and influx of silver from Japan and from the Spanish Americas. Also under reduced taxes and capitalism, this was a thriving dynasty. Silver was in high demand during the Ming period as it became the standard currency, replacing paper money. Taxes were required to be paid in silver starting in 1465. There was a widespread use of silver as currency that fueled its economic growth, and China had a massive trade surplus with Europe, exporting high-value goods like porcelain, silk, and tea in exchange for its silver. All right, let's skip ahead now to the American Gold Rush, 1848. It's a little bit before this guy's time here, but James W. Marshall, we all read about this in our history books, especially me growing up in California. He was overseeing the construction of a sawmill at Sutter's Mill in just the territory of California. It wasn't a state yet. Within a year, after a year, there would be 300,000 migrants coming in covered wagons, clipper ships, on horseback. They were known as the 49ers because they came in the year 1849. The gold rush fueled rapid economic growth and prosperity in California, and it would provide the capital to fund the Industrial Revolution in the U.S. So who is this guy? So the adventures of Samuel Clemens. I think Tavi's in Missouri right now, and Quentin's from Missouri. So this guy, Samuel Longhorn Clemens, he's from Missouri. He just wanted to be a steamboat pilot on the Mississippi River. And he achieved that at age 23 in 1859. But then the Civil War would break out in 1861. He would light out of there, as his character Huck Finn would say. He escaped conscription into the war from both sides, and he fled west to get a mining job in the silver boom town of Virginia City, Nevada, where the Comstock lode had been discovered in 1859. So he noticed that the men who were mining for gold and silver were all doing extremely hard work and were not making any money. At the same time, the mine owners who were trading paper were getting rich. So he quit his job and invested his hard-earned savings in a few gold and silver mining stocks. Well, it didn't take long for him to realize that they were worthless. Many of the Comstock-related companies traded on the San Francisco stock exchanges were total scams, insider trading frauds based on bogus discovery stories. Mark Twain's famous quip that a gold mine is a hole in the ground with a liar standing on top of it comes from this experience. Of course, Twain's life experiences made him one of America's greatest authors and humorists, but he was a notoriously bad investor. He invested millions of dollars in today's dollars in something called the Page Compositor between 1880 and 1894. It was a printing technology, but the invention was rendered obsolete in the following year by a competing technology. This failed investment along with his other speculative ventures into new technologies at the time, such as the steam generator, an engraving process, a magnetic telegraph, steam pulley, all of it caused him to lose the majority of his fortune, including his wife's estate. Twain's financial misfortunes were exacerbated by his lavish spending on things like a 25-room mansion in Hartford, entertaining frequently trips to Europe. He went bankrupt in 1894. So let's skip ahead, a few years. William Boyce Thompson, born in 1869, raised in Butte, Montana. He was a much better investor than Mark Twain. Butte was home to the Anaconda copper mine, the largest copper mine in the U.S. by 1892, and one of the largest in the world at its peak in the early 20th century. So Thompson grew up fast in this rough and tumble mining town and excelled at a young age as a poker player. His high school English teacher realized he had an unusually keen intelligence and convinced his parents to send him back east, where he was educated at Exeter and Columbia. Thompson would found his trading company, Newmont, which was short for Newmont and Montana Company, in 1921. And he listed it on the New York Curb Exchange, which would later become the American Stock Exchange in 1925. And the company's name would later be changed to Newmont Mining. But like the Comstock insiders, Thompson was a gifted stock trader and promoter, but he was not a scammer. He saw the value in building successful mining operations. He did this by hiring the very best prospectors, geologists, engineers, accountants, and legal advisors, and built a tremendously profitable copper mining conglomerate during his lifetime. He died a rich man at the age of 61 in 1930, worth about $2 billion in today's dollars, though that was well off his peak on account of the Depression. But his foundational principles of hiring the best in the business would turn his trading company into ongoing operating business that would become the largest gold mining company in the world. His story is told in the book that was written in 1972. The book was called Men and Mines of Newmont, a 50-year history by Robert H. Ramsey. And the book is out of print today, but we all have a bunch of copies, and this book is revered at Crescat like the Bible. If someone had bought 100 shares of Newmont when it went public in 1925 at $40, and this is how the author tells it in 1972, and had neither bought nor sold thereafter, he would now own, through stock splits and dividends, 4,330 shares, worth, and this is just February 1972, worth about $140,000. So over that time period, Newmont had returned 3,400%. A 35 bagger, not bad. But Well, why don't you just go on to the next here? But remember, this was written in 1972. So what happened in 73, 74? This was of course, gold had been, the dollar had been depegged from gold at this point by Nixon, and it would take off. And in 73, 74, the Barron's Gold Mining Index would go up 5x. So you could take that 35 bagger and multiply it by about another 5 in just 2 years, because I believe Newmont was a part of this index. It's crazy because the Bloomberg data doesn't go back this far, and you could pay the Chicago CRISP people for the data, and they charge you an arm and a leg. We need to go back and find the actual return data for Newmont over this period, but I have a feeling that it was at least 5x. And guess what? The S&P 500 was down 50% in those same 2 years. What did we come off of? We came off of one of the most speculative growth stock bubbles that we'd ever had in 1972. The Nifty 50, technology and large cap growth companies were decimated over that period. Why? Because that's when we had rising inflation, rising interest rates, and rising inflation at the same time, and a huge bull market for precious metals. We think we're coming up on one of those bull markets for precious metals. But I want to just finish by talking a little bit about another mining scam that happened in around 1995. So a lot of you have heard of Bre-X. So the Bre-X mining scandals was one of the biggest corporate frauds in Canadian history. It made the Comstock mining schemes look like child play. In 93, a Filipino prospector named Michael de Guzman claimed to have discovered a massive gold deposit in the Busong region of Indonesia while he was working for this small Canadian mining company called Bre-X. And in the next few years, the Bre-X stock price would skyrocket. It just became a multi-billion-dollar discovery. They had claimed that the estimated size of their gold deposit was over 200 million ounces. And this would literally be the largest gold discovery ever. I think there's probably one larger in South Africa, right, Quentin? But it would rival that. And well, it turns out that the gold samples that de Guzman had provided were later found to be salted or artificially enriched with gold. It was the same trick that the Comstock insiders had employed. Comstock insiders, they just took gold coins and they melted them down. And then, so they were assaying pure silver. But when Freeport-McMoRan was brought in to help extract the gold at Bre-X, they soon discovered that the entire thing was fraud. And this guy de Guzman died in a suspicious helicopter accident, leading many to speculate that he may have faked his death. But the Bre-X scandal, really. Clinton can tell you a lot more about it because it happened when he was, really in the early stages of his career, and he had to take a sabbatical to go work as a high school teacher for a while because you couldn't even get a job in the mining industry at that time. But in the wake of Bre-X, the Canadian regulators instituted a new whole set of investor protection for investing in mining securities. And it's called NI 43101. And now the Canadian stock exchanges are the destination for most of the mining companies in the world because it has the best investor protections. So, compared to before Bre-X, they now have a qualified person requirement where a qualified geologist or engineer has to sign off on all kinds of technical reports all along the way. Consistent standardization now and for reporting of mineral resources and reserves. These independent technical reports now need to be filed at various stages of the mining projects, and the disclosure requirements are much more extensive and transparent for investor protection, and not that mining is not without risk, but there's just much more protections in place for reporting of material changes, for protection against misleading information. But nonetheless, that the reputation that the mining industry has, through all of this history, going back to Comstock and to Bre-X, it's an extra hurdle that really explains why this industry is still so depressed. But something to think about. But for us, having an expert like Quentin on our team really helping us to vet the opportunities here, extremely important. And that's about it for me. So sorry for taking up so much time. All this stuff is in our most recent letter that we just put out. I encourage you to go check it out. And I'm going to flip it over now to Tavi.
All right. Thanks, Kevin. Sorry.
Okay, there you go.
Thank you. Just wanted to say that, I suggest everybody to read the letter. It's a really interesting letter. Especially, I like the whole letter, but I especially like towards the end of it, where he describes a little bit more regarding the history of the monetary system, and also the history of mining, and some other things regarding Mark Twain, which, after seeing his picture of that mustache, maybe I need to grow one as well. All right, let's get started. Something that came to my mind, Kevin, as I read through your idea regarding the history of the Chinese inventing fiat currency, or fiat money, I should say. It's interesting because it reminds me a little bit of the crypto space. It's not to say, a lot of people think that when you're not necessarily a supportive of the idea of Bitcoin, for instance, is as a standalone currency to compete with gold, for instance, let's say. I think we forget that we did go through a fiat revolution during that time. I mean, economies and governments went through a long period until today where fiat money is still used in a big way. Now, not having a view, or at least not having a positive view about Bitcoin as a currency, isn't necessarily a view that we won't see digital currencies. I actually think that's going to be highly likely, but it's just, to me, it's just much more of a byproduct of excessive liquidity, and valuing something towards an encryption reminds me of valuing something towards the hope of having physical gold to back a currency. I mean, that's to me what it sounds like. And I much rather own gold. And this is not coming from a person who is a gold bug. I am not a gold bug. I believe in gold first and foremost, because of the macro reasons that we should be owning gold today. Because I appreciate history, number one, and looking back and understanding how assets tend to go to cycles, especially secular cycles. I just have a very strong conviction that we're going through another secular movement for gold, and when those check, usually you have a domino effect in the macro space, and that's what this presentation is going to be about. There's something that I notice about commodities is the fact that you usually, when you are in a commodities bull market, you tend to go through a rotation, and it's remarkable how this tends to unfold, because this rotation essentially is also happens in the media overall. Basically, there's a commodity that is more prominent in terms of narrative, and I can recall back in 2021, this happened with lumber. Lumber was surging in prices. And then what did we see? When lumber prices began to plunge, the media came out saying inflation is over because lumber prices are back down. But what they miss was the fact that it rotates. And this it's not a unique effect. It really is interconnected across all commodities. And so once one starts to fall, the next one starts to rise. Recently, we had this phenomena happening with orange juice. Orange juice went up significantly, then declined. And now cocoa is the next one. Cocoa was basically making new highs, levels we haven't seen in many periods in history. Um, and now it's coming back to earth. And guess what? What's happening now? Natural gas prices are starting to rise, and nobody is paying attention to it. Let's go to the next chart. And to me, this is one of the most asymmetric opportunities in markets right now when it comes to this commodity rotation approach. You can look at this in different ways in the natural gas prices. I think last week, and I'll have this chart in the following slide that shows that we're basically retesting a major bottom, meaning we've been here before, and the times we've been here before marked major bottoms for natural gas prices. Now, one thing that is important to look at is the futures curve. So you have a natural gas contract in the futures market, and you can look at the spread between what is the current price versus the price a year from now. In this case, actually, I'm looking at the other way. I'm looking at the price that is going to be a year from now versus the current price. And when you have a contango, so there's a contango in backwardation. Backwardation means that the future price is lower than the present. And a contango means that the future price is higher, or the longer dated contract should say, has a higher price than the present or the front month contract. In this case, this is exactly what's going on. Now, if you dated this, if you go back and look at what were other contangos in history, using the word contango in plural here, clearly that also marked a bottom for natural gas prices as well. Well, that's really interesting because this is the second steepest contango in history. You know what this reminds me of? Oil prices. Back in April of 2020, oil prices had a ton of inventories. We had a flood in the markets. People were saying that oil prices would never go back up, and we had negative prices in WTI. And guess what? The contango of oil prices during that time was also quite significant. The main reason for that contango, in fact, was futures and the long dated contracts were starting to rise, but also we saw a huge decline in the front month contracts. That reminds me of today. That is not to say that inventories are not, flooding the market today for maybe political reasons, maybe just the case. But when I see this need for energy, electricity, the shortage that is likely to come from electric cars and electric heating and the AI revolution, and seeing CEOs of natural gas companies come out and say, look, I mean, the demand is going to be exploding here if we don't do anything about this. This to me is quite concerning, but also a way to express that view in the markets that I think it's quite mispriced currently in markets. If we go to the next chart, that shows the chart I was referring to, which is those bottoms in the past. And if you go to the next one, it kind of shows where those appreciations that came about after hitting those bottoms. And we've had some quite significant numbers here in terms of the appreciation. And interestingly, when I look at this price and this relationship of with history, first thing that comes to mind is, how do you express that view? Is in the equity markets? Should we be buying the commodity? And we have a view about energy companies. We think energy companies are exceptionally cheap, especially from a free cash flow perspective, how much they have in margins and so forth. Can go on and on and on, and why we think that the energy space looks historically undervalued. But it's hard to find a natural gas producer that looks like this chart. Yes, they're cheap, but none of them look like this chart, meaning literally in the dumps when it comes to looking at the historical price chart. Now, if you go to the next chart, the other thing that comes to mind is the fact that even if you looked at, it's coming from a person who is also bullish on oil. I actually think, just like most commodities that are chasing the Russian invasion high levels that we had in June of 2022, while the invasion happened 1 or 2 months before that, with prices really reached a peak back in the June of 2022. If you notice, a lot of commodities have been chasing those levels recently, and I think we're going to go there across most of those those hard assets. And interestingly, even relative to oil prices, you can see clearly nat gas is really cheap. The prior time that we saw this oil to nat gas spread, what we call this BTU spread, because it's adjusted by on a BTU basis, you can see here that the prior time was actually in 2012 in April. And if you go back, just go back one chart if you don't mind, Nathaniel, you can see that back in 2012, we saw basically a very large appreciation of natural gas prices coming out from there. And I actually think that is very plausible to see something like that today. It's just my opinion. And so at Crescat, we're actually long natural gas future contracts. And people ask me, how do you do this? Well, if you look at the long dated contracts, and that's a function of the fact that we have such a large contango, they have started to move already. And so we're not necessarily long the very first the next month, front month, but certainly the shorter dated contracts are the ones that we think look more attractive today. So let's go to the jump two charts. There we go. Well, I talked about this phenomenon that is happening today in markets as well, and there's always something that is somewhat illogical, and it doesn't sound rational in the macro world, and to me that's one of them. And I talked about we all maybe agree that there's a new era of interest rates, while 2 years ago that was very difficult to make that case. I think today a lot of people would agree that interest rates are likely to stay higher for longer. And that's really on the back of many things. It's not just inflation. Inflation is a huge component of that, but also the large amount of issuances that we're seeing in the Treasury markets. And you can go back and see some of our research back in 2021. And so we were talking about this risk of issuances is starting to cause interest rates to rise, especially in the long end. Now, what we haven't seen yet is if you're a company borrowing capital at 4%, and now you're borrowing capital at double that amount, which is the case in the junk space in particular, I would say that the risk for default of that company should be rising in tandem. And we just haven't seen that yet. So this is one, the white line there, you've seen this, is the credit risk, is basically looking at the credit spread between the corporate bond versus a risk-free, supposedly, or the Treasury market interest rate. And you can see that the differential between the two are one of the lowest we've seen in history. In fact, depending on the spread, is one of the lowest we've seen in 3 to 4 decades, which is sort of shocking, really. Let's go to the next chart. And so what's happening as well on top of all this is that we're starting to see some reacceleration of inflation. It started with most of commodities. We talked about this potential for a second wave, and that sort of started happening indeed. And now we're seeing this starting to also unfold in the housing market. Interestingly, if you look at the house prices, they began to actually rise again. And this is, by the way, is very similar to commodities. We just have not fixed the structural problem of the housing market, which is shortage of inventories. We're going to have to build more. But in order to build more, we need more materials. And in order to get more materials, we need more commodities. And commodities have been through, as we all know, a long time, a chronic decade or so of underinvestments, and which is also causing this constraint of supply. And so how in the world do we fix the inflation problem from a housing perspective or commodity perspective? Well, we need to either build homes or create a massive crash in the economy, which I don't think that the Fed will allow that to occur in a large way that we saw back in 2008, because we have the printing press today. So that is even more likely to happen. So if we go to the next chart, despite all the concerns about the housing prices, we're seeing the housing market basically climb a wall of worry. This is the month-over-month prices of houses in the U.S., which I know I'm onto something when I tweet something and nobody really enjoys it. And that's the thing that really catches my attention, because I know this is a big problem. It's rising at about 12% annualized rate if you look at this chart. If you take away the pandemic-related surges that we've had in 2021, 2022, look, you can see clearly that this is the largest month-over-month increase that we've seen in the history of this data. This is government data. For those that believe that government actually suppresses inflation and so forth, which I'm in that camp, by the way, I do think government data is understating what the inflation number really is. Well, think about this. This is actually government data showing you that month over month, housing market is growing at 1.2%, which annualized will give you a double-digit number. So keep that in mind. And this is such an important chart. How do you fix that? We got to build homes. And this is, to me, it's also a critical part of our own commodity conviction in terms of the thesis moving forward. That is not to say reshoring and green revolution won't be also a huge part of this, but this is an important component of that thesis as well. Let's go to the next chart. I thought this was interesting because that was a news on Insiders. The Biden's top economist says that the key to ending the housing crisis is giving cities and developers monetary incentives to build more affordable homes. Now, I don't care political views, but that's probably what's going to end up. I mean, there's a reason why Warren Buffett owns home builders. It's because I think it's way ahead of the curve on this. And, most likely we're going to have to see a boom of construction before we see some issues emerging in terms of prices. Let's go to the next chart. And to me, this is going to be why inflation will be sticky as well, because housing is a huge component of inflation. And if you think about how much we as consumers spend on housing as part of our paychecks or whatever you have, your wealth, it certainly is a big chunk of all of us. And to me, this ties back to a macro idea that we've been talking about in this presentations for a while, which is the idea of the steepening of the yield curve, which recently has started to gain some momentum on the upside. Caused mostly, I should say, not really by the 30-year yield rising, but really because the 2-year yield has been declining. Today was one of the largest declines in the two-year yield that we've seen in many years. By the way, when the yield curve starts steepening again, that's usually a sign of a recession, especially when you're coming from deeply inverted levels. And I think that will be the case again. I don't think this is I often think about, if we're looking at yield curve is inverted, it's starting to steepen. That's a recession sign. And you look at unemployment rates that came out today, in fact, and is starting to rise as well, clearly in a year-over-year change of growth to the upside, clearly. What does that mean? That means that we went from everyone pricing in the curve that the Fed was going to cut rates by 7 times to basically close to 1, and now we're back to 2 or 3. I think we can see more cuts personally. When I see that move in the market's expectations, I tend to take the other side of it, and I think there's reasons for it, and one of them is the potential for a recession. And I know inflation is hot. I think most of I'm of the view that inflation is here to stay. But we're probably in a stagflationary environment. In a stagflationary environment, the Fed doesn't have much that it can do. And so cutting interest rates and finding reasons to cut interest rates are probably going to be easier moving forward, because I think we're going to see some level of weakness coming from the fact that interest rates are already at very high levels, and the system just cannot endure those types of cost of debt and cost of capital overall. Let's go to the next chart. And so here's an interesting thing, because we're seeing earnings coming out, and I pay close attention, and Crescat pays close attention to earnings too. We go through different ways of looking at sectors and industries that we think look interesting on the long or short side, and what we're seeing in terms of the commentaries. Some of my points would be looking at a lot of the discretionary companies. I find it interesting that affordability is starting to become a problem. And that's a problem also in the housing market, not to get there again. But it's really interesting that we're starting to see some of those commentaries begin to show that. But look at the divergence of diluted earnings per share between large and small caps. I mean, we all know that large cap companies have been leading the market recently. But it's interesting as well if you dive in deeper into the fundamentals of those two segments of the market. You can see clearly that the red line, which is Russell 2000, smaller companies, are definitely in a contraction already in terms of a trend of their earnings, and we're still seeing the S&P 500 companies seeing an upward trend, and you can see that back in 2019 that was the case as well. The small cap companies led the way to the downside. Large cap companies were up in terms of fundamentals. Oh, look back in 06. I think actually 05, 06 was also the case. Guess what peaked first? Russell 2000. The small cap companies, they're peaked. And then later on, we had the large cap companies peaking. And one phenomenon that didn't happen was in the early 2000s, we actually saw both having this issue together. So now I'm paying close attention to this because I'm not as bearish on small caps, because I can see small caps actually outperforming moving forward. If you study what happened in the 70s, small cap companies actually outperformed large cap companies, which in today's environment would be unthinkable. But remember, markets like to do things that are outside of the conventional wisdom. That was the whole point of the prior presentation. And so it wouldn't surprise me if the next 10 years is an incredible decade for small cap companies, which is, I guess, one of the reasons as well why we feel comfortable investing in small cap companies in the mining industry. Let's go to the next chart. But pay attention to this, because majority of the employment in the U.S. economy comes from where? Comes from small cap companies. Only 18% of employment comes from the S&P 500 companies. If you look at this data from Apollo, and so as you see this contraction of fundamentals coming from small companies, you should see some reflection of that into the labor markets, which should be starting to show some weakness. That's what we're seeing as well. Unemployment rates are starting to rise, and that's probably just the beginning. Unemployment rates, when they cross their own 24-month moving average, it's a 2-year moving average, they never look back. They usually go up from there. This is what history shows us. It's not my opinion. We've never seen a time when unemployment rate crossed the 2-year moving average and actually crossed again on the way down. No, that never happened. Usually we tend to see is an upward trend in unemployment rates, that from there you tend to see a deterioration of the economy as well. So, this is why when I see that small cap companies are actually struggling, most likely this is going to be impacting labor markets too. Let's go to the next chart. So you can see here that, I don't like the title of this chart. It's from Jeffries. Great chart, by the way. But it basically shows, and the reason why I like this chart is because it goes back to the 1930s and shows you that throughout history, this is one of the lowest times that we've seen the percentage of small cap companies relative to the total market. So no, that is very much in line with what we are seeing as well in the mining space. I mean, certainly the mining industry has got no love, especially the small cap companies. And this is a translation of that too here in this chart, showing that usually that's unsustainable. We tend to see this to be a secular move as well. Back in the 70s, as shows in this chart, we had a huge move, or the small cap percentage as a total percentage of as a total part of the market cap, it started to rise during that decade in a large way. And I think that will probably be the case here again. Let's go to the next chart. And you can see here too, through just looking at fundamentals, so valuation, the PE ratio of a small company versus a large company, it has the steepest discount that we've seen in the history of this chart. And going back again to the 70s was a great time to be invested in small companies versus large cap companies. And back after the tech bubble in the early 2000s also coincided with where we are today in terms of valuation. So, where do we go from here? Well, we'll probably, if given our views, is that small cap companies are likely to gain some momentum on the upside. By the way, this is not, it's all linked. It's emerging markets, it's commodities, it's small cap companies, it's emerging markets, foreign currencies, their bond markets. Everything is sort of moving in the same direction. And I think they're going to start taking leadership more and more over time. And we saw some of that with energy companies. the value to growth rotation, which I'm going to touch on this. If you go to the next chart, you can see a similar research going back as well to a few decades all the way back, and you can see here clearly that there's also secular changes between growth to value. The rotation of growth to value also tends to unfold in a secular manner. We saw that back. So the blue line is declining. That just means that basically value is underperforming growth. Recently, we've seen basically a bottom of this trend where value started to outperform growth. This is mostly driven, again, by industrials, some energy companies. We saw some other commodities actually doing well. Even copper producers are starting to perform better. And this is slowly, things don't happen quickly. I mean, they slowly start to spread around, and you start seeing those types of outperformances occur more often. And therefore, this blue line starts to go and solidify an upward trend. So in our view, this is probably going to be the case. I think Kevin had a good retweet over the week that I thought was interesting, that a whole thought about how growth companies usually never realize that growth that is expected by analysts. And that's an interesting thought. We usually see that in emerging markets. In fact, emerging markets are emerging economies. Brazil has been an emerging market since I was born, never emerged to be a developed economy. And it probably will be the case when I die. So it is what it is. We're probably never going to realize this whole idea of emerging to a developed economy, but that's just what it is. Let's go to the next chart. This is another way of thinking about the same idea, just looking at the P ratio of value versus growth back in the tech bubble. And I call it bust. It should be bubble, sorry. But the tech bubble environment, we also saw the value to growth PE ratio differential being very historically out of line. And clearly that was the case. Value was very cheap relative to growth. And we saw this actually in very similar levels back in peak of 2021, in which in some metrics we're retesting those levels in terms of how expensive the market is right now. But really, I think this is a trend that as you can see in the prior trend, when we reach those lows, we tend to go to a period where value tends to outperform over time. And I do think that will be the case again. Let's go to the next chart. You can also see that even from a cost perspective, as you increase the cost of capital, investors tend to start thinking more about profitability. And that's the whole reason why actually in an inflationary era where you see hard assets rallying significantly, inherently improves your pricing power. And therefore, commodity businesses actually tend to have higher profitability during inflationary eras, not all the time. And so in this period right here, you're seeing 10-year yields rising and people continuing to value growth more than actually value stocks. So you're seeing here, the white line really is the global value versus growth stocks, and the blue line is 10-year yields. And you can see here that the blue line is rising. You would suspect that the white line is going to start following along, which means value investments is starting to outperform growth investments. Let's go to the next chart. Brazilian equities would be a good example of that. It's in line with the fact that we've seen small caps underperform and value underperform. Emerging markets are also part of that. And so you're seeing Brazilian equities recently, basically poke their head out of this major resistance, which is probably a few decades resistance, as you can see in this chart. And after breaching that level, it actually retested that level again, which is usually in a technical world that tends to happen actually. And now people lose the belief that this is an actual trend, but usually what we tend to see is the continuation on the upside. And so this is why I tend to be very bullish in Brazilian equities overall. I think most of the pessimism is already priced into the valuations that we're paying for those companies now. Let's go to the next chart. Let's dive in a little more into the commodity space here in a second. But the technology companies as well. And you think about more broadly speaking on the 60-40 portfolio, 60-40 portfolios, when you think about the 60 portion, which is equities, majority of that is coming from technology companies. And it's kind of scary to see that the correlation between tech and treasuries are so high, because they are basically relying on the treasury side of the book to save them when tech stocks don't do very well. But the correlation between those two segments of the market have never been higher, or maybe it was higher, as you can see in this chart back in the early 2000s. And actually, I like this chart, but I don't like it that much, because the early 2000s wasn't as comparable to today in terms of the inflation problem, which is, I think, should be a little bit more emphasized here, given this idea of treasuries research, because the treasury market is going through something that resembles what happened in the 70s, in the sense of central banks actually accumulating gold rather than treasuries, and that's what's causing this issue. But as we see interest rates being pressured higher because of the selling pressure coming from central banks and or other institutions, and inflation and supply and so forth, ultimately it should also have an impact on the technology companies' valuations too. Let's go to the next chart. And so a phenomenon is happening now that is important to notice, is what's happening with Japan intervening in their markets, trying to prop up their currency. I've shown this chart before, where it shows the devaluation of the yen versus the rising inflation expectations. This is not a Japan only sort of phenomenon. This is happening globally, where we're seeing the rise of inflation expectations. And even with that, central banks are struggling, coming up with ideas to really be able to stop inflation from rising, from developing in their own economies. And as a result of that, we tend to see the devaluation of fiat currencies. This is why commodities have been doing so well, and probably this is the beginning of a trend, not the end of one. Now, I thought, an elegant way to describe what's happening is maybe in the next slide, in which Ronnie had this tweet. It says the biggest piece of M&A in the past 12 months was the merger of the Treasury and the Fed. And this is a quote from Michael Hartnett. And I thought that was a great quote. I thought that was a clever quote, because it's happening not just here in the U.S., but it's happening across other developed. Of course, it's not a real M&A or anything like that. Don't take this. It's more of a figure. Figuratively rather, but it's an interesting way of a concept to explain the situation quite well. Let's go to the next chart. And so if you look at the S&P 500 in gold terms, we've gone sideways since 2017, actually. And while I'm not a real technical analyst, I just can't help myself but look at this massive head and shoulder formation that has been happening since 2017 or so. And you can see here that suggests that maybe this chart, the white line, should actually be going lower as we see gold outperforming. It's particularly interesting, this chart, because this whole idea of the S&P 500 declining relative to gold terms is something that happens quite often after we see yield curve inversions. And so we've done deep researches on this, and research pieces on this, and certainly that's the case statistically, and I think that will be the case again today. Let's go to the next chart. But more interestingly, you can see this across the other commodities. It's not just the gold, the S&P 500 in gold terms, but look at the oil relationship versus the S&P 500. This is such an interesting chart. You go back to the 1930s. It's really hard to find a time in history where oil has been this cheap relative to the S&P 500. Now you can say, well, it's not a fair comparison, because S&P 500 is measuring the performance of companies that have cash flowing vehicles, and that's fine. But throughout history, we usually retest those levels, and we tend to see upper momentum in this chart, and which I think will happen again. And we tend to see this over history. In the 70s was the case, in the early 2000s was the case as well. I think certainly we're going to see this again in a commodity cycle. Let's go to the next chart. And so you can see here the price of oil adjusted for gold, which is really interesting. There's times when it gets historically expensive, times it gets historically cheap. Now, while we are gold bulls, it is interesting that oil is also really cheap historically right now, relative to gold as well. So this is an interesting idea because, as you can see here, there's major bottoms in the past. This chart goes back to the 1920s, and oil relative to gold, as you can see clearly here, have shown many times that it can actually hit a major bottom and start an upward trend. It's probably going to be the case here again with the supply side being such difficult situation as well. Let's go to the next chart. And you can see as well with copper prices. Now, there may be a reason why we haven't seen true inflation as much as we saw in the 70s and beginning to see now. But in the last decade is the fact that most commodities have actually underperformed gold, have underperformed the metal. And I think gold is a great proxy for inflation. So copper is trading currently in the same level it was trading back in the 90s in relative to gold. Now, if we think that gold is entering a bull market, imagine what's going to happen with copper prices. And maybe the next chart is even more interesting because it shows a sort of head and shoulders, inverse head and shoulders of copper adjusted to gold. But if you go to the next chart, there's a guy here in this presentation that really likes zinc, and zinc is also, if you look at zinc in gold terms, oh boy, I mean, this is one of the lowest levels we've seen in the history of the metal, and also looks really attractive. Look at what happened in the early 2000s in that ramp up in prices that we saw relative to the metal as well. Let's go to the next chart. And you can see as well the mining industry relative to gold also looks the same way. We've been in a downward trend. A lot of people have lost faith in this chart. It kind of looks like the Brazilian equities chart as well. And all of those are probably prone to or poised to a major breakout. As we see that happening, it probably will unleash a long-term trend. And that's the whole point of this chart. And I think we're so close to something like that, very meaningful. A lot of people have lost faith on the potential for such appreciation. And I think we're long overdue for one of those large appreciations that we tend to see along with gold prices. Gold prices went up a lot recently. Now we've taken a break. It's nice to see that we didn't really see a crash in prices in this recent break in gold prices. And so it makes me think that, and also on the days that gold prices were down, we actually saw the mining stocks do quite well, which makes me think that we're getting really close to something very meaningful in this industry. Let's go to the next chart. I'm almost done. And you can see here the valuation, which is where we really lean our research on, is looking at valuations. And this is an interesting chart from Financial Times going back in history of the price versus the net asset value of the mining companies trading at lowest levels in 40 years, which to me is another way of thinking about this opportunity on the long term. I think this is my last chart, but two more charts actually. This is the metals and mining industry, just looking at transactions of M&A. Look how interesting this chart is. I know we've seen back in 06, 07, we've seen a very large amount of M&A transactions. We're starting to see the pickup of M&A. And 2021, we actually have 0 transactions during that time, which only happened back in 1995. We're starting to see some of those. But remember, the major companies are facing a problem of especially the gold space, where ore is deteriorating in quality. Average grade is in a declining trend. And so we're likely to see more M&A transactions happen. You can see this in dollar terms, or you can see this in number of transactions, which is the next chart. If you look at the next chart, you can see number of transactions, also an interesting one, in which kind of resembles this beginning of the early 2000s when things kind of picked up from there. So, we're just at the beginning here. This is what this chart shows. And those are transactions that were completed above $1 billion. And you can see clearly here that this is probably just the early stages of that, as we see the miners starting to make money and finally be able to move towards M&A and other types of decisions that they may make. Let's go. I think I'm done now. Let's see if that's it. Quentin, you take it from here.
All right, Tommy. Thank you very much. Look, we like to get our hands dirty here at Crescat. And quite frankly, we are an activist institution here, Larry Fund. We're activist investors. We try to be constructive. Okay, we're fairly constructive people. Kevin and Tommy can speak for themselves, but as far as I'm concerned, my role is to work with our junior mining portfolio. Those companies that Kevin talked about early on that are drilling with 114 drills this year. To try to maximize their chances of success. I mean, that's what it's all about here. Like we take our investments mainly in exploration companies to generate value through success with the drill bit. And one of the things I guess I'm finding myself doing lately, mostly, okay, like if I had to say where I'm allocating most of my time is towards companies that need to get a restart. Okay, they have they did well maybe back in 2020, 21, even into 22, but over the past couple of years have either gone kind of turtle-like, they've pulled in their head and hidden for a while the market's terrible. Some have saved their cash, which is good. That's always a good thing. But others, they still have their really good projects that we're excited about, but they need to get going again. Okay, so I'm spending a lot of my time doing what I'll call overhaul work, and I enjoy it. I actually like it a lot. This is where I, feel like I can contribute quite a bit. And, in terms of what I've been doing, it ranges anywhere from, helping a company with its data and interpretations and in anticipation of coming back and drilling again. Great example of that. I'm working with Condor here recently, my good friend Ever Marquez, and we're going to get that thing fired up again. I've had a discussion with Chris Bunsick earlier this week, and I can't wait to start telling that story again. It was an amazing story, had a good run. Results were not quite what we hoped for, but does it mean there isn't more there? Absolutely. They had actually better results than a lot of exploration stories these days. So I really want to see them follow up. That's just one example. Other companies, I'm working towards helping find people. There is a chronic shortage, industry-wide of technical people, also people to manage these companies. And we're playing a pretty important role in getting people squared away. I'm looking at, pretty heavyweight person who can come in and help one or two of our Nevada stories, for example. Okay. I'm working on that right now, but long story short, there's a lot of fixing that has to be done. This is the time to do it. The market's turned and it's starting to pick up. And I would say all of these companies, all these great stories that we've been talking about for the past 3 years, they will show life again. Okay. Things are going to come roaring back and we're going to get things back in the saddle. So, as I talk about these stories, especially giving updates and stuff, listen up, because this is where we're putting our time, our money, and so forth. And I think those who invest with Crescat will be beneficiaries of that. Okay, let's go to the next slide. Now, I always touch on this. I try to do it about once a month. And I know it gets a bit old for some people, but I think it's just always good to have a bit of a reality check around what the cyclicity in the gold space in particular is doing. And what you see here is gold price going back about 23 years to 2001. You can see the MACD, the histogram for MACD on the bottom there, and then the gold price with bars, green bars. The bars define periods where the MACD is positive. Basically, it's above zero. And we're in one of those periods, okay? And the average length of those periods across this time span is about 24 months. It's not to say that all we have is, say, another 12 months or so to go on this run. I actually think this one has something kind of special to it, so it might be more like that green bar way over there on the left. It might actually be maybe a 3-year run or something like that. But we'll see. But the average increase in gold price within one of these green bars is about 1.68x. Okay, so the price of gold from the low point inside that green bar to the high point moved up by 1.68 times. And I really do think, March or so of last year, 2023, I think we hit that low. In other words, the MACD kind of ticked up, and you can see it's been positive ever since. In fact, it's accelerating here. Where will it head? If history dictates, then 1.68 times that $1,800 gold price should put us maybe up around 30 or 3,026 thereabouts. Okay, so I'm not saying that's going to be all. There's going to be more time after that. Maybe it even goes up more. You can see some of these moves in gold, individual moves are actually quite a bit higher than that, up to 2.09x there in the period from 2009 to 2012. Right, but we have a lot of good things coming, and gold is usually the leader. Okay, I think Tavi mentioned that a second ago. Usually, other metals, copper in particular, tends to follow. Silver as well. Okay, so I think what we're seeing with gold is starting to cascade down. Copper is at $4.50 now. It's up 50 cents more or less since earlier this year. Silver is at $26.50 or thereabouts. That's up from about 22 earlier this year, and they're all going to start moving. Like they kind of move in a herd. Okay, so we got a lot of good things coming, and we have a lot of exciting stories. Now let's go to the next slide. Now, as things start to pick up again, we're starting to see a lot more updates. Okay, so for 3 or 4 weeks there, back earlier this year, I maybe had 1 or 2 updates, a presentation, but this week I actually have a whole bunch of them. I think I got, 1, 2, 3, 4, 5, 6, 7, 8, I believe, 8 present updates that I have to give. So when it rains, it pours. I've got to spend most of my time giving updates, and I will try to do this as expeditiously as possible. Go to the next slide. Okay, Snowline. Look, I cannot think of a company that has executed better than Snowline at all levels. Okay, on the technical side, on the corporate side, on the money raising side. I mean, I got to give it to Scott and his team all the credit. It's just phenomenal what these guys do. In this case, this news this week was about their discovery of new zones, new and reduced intrusive discoveries around the Rogue property and also down at the Cynthia property. If you remember, they picked up Cynthia from Strike Point, I believe it was, a couple of years ago in the early stages of discovery at Valley. That's a smart thing to do. When you're onto a big discovery, you grab land, okay? And they did it, okay? So they grabbed the land down to the south, and now they have a nice new, very exciting reduced intrusive target I'm going to talk about. Okay, so what do we have here? We got 4 new targets in addition to Valley. Valley's right there in the middle. Okay, but we have 3, so Ramsey, Livia, and Duke up on the Rogue property, and then Sydney, which is down on the Cynthia property. And we're going to talk about each one of these briefly so you can see what they're doing. These guys are going out. They're not going to stop at Valley. They're going to make multiple discoveries of this type. Go to the next slide. Okay, this is up at Livia. There's actually another target right adjacent. So I suppose you could just think of these as the same target, but Aurelius is off to the west there. So you got 2 boxes defining each target. I remember talking to Scott about this in 2014 when they had early data around this old cabin Pluton. I remember seeing the Blake samples back then, the stream sediment stuff, and just pie in the sky. Maybe there could be more of these reduced intrusive things out here. We talked, about what could be done. Now they've done the work. Okay, and what does the work yield? Look at all this anomalism here. You got both soils and rock chip samples. Okay, the little circles are soils, so they would do traverses and they collect soils every few meters, say 50 meters or so, and they're seeing widespread anomalism associated with these intrusions, these little reduced intrusive bodies that are sticking their nose up in this area, and it really goes for both property. I mean, I would almost think of this as one giant system, quite frankly. But now they also did rock chip sampling, and look at some of the numbers. Sometimes, you get lucky out in the field and there might be a face of rock a few meters wide, 2-3 meters wide, where you can chip channel a sample across that face. And they actually did that in a few locations here. You can see that outcrop down there at the bottom, 3.3 meters of 5.1 grams. So they have tangible, stockwork, sheeted vein, call it quartz veining, like you would see at Valley, over 3.3 meters. Yeah, it's just what the size of the outcrop was. Probably is more to it. Okay, so when they drill it, I wouldn't be surprised if they come away finding something, much bigger. But the takeaway here: 18 and 19 samples, average 2.2 gram per ton. That smells very much like the grades that we see at Valley. Okay, right there in the middle, you can see 18 of 19 samples in that area that the arrow is pointing, average 2.2 gram. That is basically the kind of grades we see at Valley. This could be another discovery. So this slide, I don't want everybody to think this is one target. Okay, you have multiple reduced intrusive bodies poking their nose up here, each one of which could be a Valley type discovery. This is an extraordinarily well-endowed gold footprint. If there isn't a major discovery in there, I'll eat my shorts. Okay, they're onto something. All right, but it just gets better. Let's go to the next slide. Now we're going to go down to Sydney. This is the one that was on the Cynthia ground, so way down towards the southern end. And this is ground they picked up for cheap, cheapest chips, like practically nothing. Okay, and they did a little bit of work here, not as much as they did on the previous slide, Libya. But look, this shows you the kind of discovery you can make in this day and age. I mean, as a geologist, I get very excited about this because there's a lot of places where we've basically, picked over the surface. This is fresh, new discovery. It's so exciting to see. They have a number of rock chip samples here that are very, very high grade, up to, like that 14 grammer up at the top. But here's what's even more exciting. Go to the next slide. They see sheeted veining, okay? Like this is sticking out of the ground, staring them in the face, okay? The arrow that I put over here on the left-hand side points to little linear features that you see crisscrossing that outcrop. Those are little tiny quartz veins, each one of them. And they're seeing the sheeted veining. So sheeted meaning, one after another, just like we saw at Valley, okay? Like if that photo doesn't look like the one over here on the right, which we now know is probably a 10 plus million ounce gold deposit, again, I'll eat my shorts. Okay, that's incredible. Okay, so Libya, winner. We had multiple targets there. Now we're down at Sydney. Oh, wow, this is sticking out of the ground. I can't wait to see a drill go into this puppy. Okay, everybody thinks that like Snowline's kind of peaked out or something. Are you crazy? We're talking about quantum leaps here. You could have multiple discoveries like Valley staring us in the face, and these guys have done a fantastic job. But go to the next slide. Okay, these two don't have any images or photographs, to throw at you. But if you read the text here, sheeted veins. Look at there, that Ramsey target. They mentioned sheeted veins, and then guess what? They mentioned outcropping bismuth minerals, and people say, "What the heck is this nuthead talking about?" Look, if I'm out in the field and I'm looking for a reduced intrusive, and I whack a piece of granite with sheeted veins in it, and I look and I see little gray speckadoos, bismuth minerals, I know I'm onto something. Okay. And in fact, they see that here. Okay. This is incredible. So Ramsey, yet another Duke target. Now look at this one. I think this one, if I remember right, one of these puppies has a big assay in it. My eyes are so terrible. Thank you, Nathaniel. There it is. Sorry. Ramsey was the one with the 86.5 gram per ton. Holy guacamole. I mean, that's crazy. Okay. You don't walk up to an outcrop every day and hit, nearly 3 ounces of gold per ton. So Ramsey has sheeted veins, bismuth, all the bells and whistles, and already seeing high grade. Wow. Okay. And then this Duke target, you read through all of this verbiage, this geobabble. It's like, oh, what is this nonsense? And again, they're seeing sheeted veins, 10 veins per meter. Oh my gosh, over an area 500 by 350 meters. Just make a picture in your head. Sheeted veins, those little tiny veins, 10 of them per meter, okay? Over an area 500 by 350. I mean, that's crazy. That's almost the size of Valley, okay? Like, again, each one of these can be a new valley type discovery. If people don't get that, heaven help us, because these guys could find, like, okay, great, they're whatever, $5 or $6 a share right now, wonderful, but they could be, they could add value in multiples here with these discoveries. This is crazy stuff. All right, go to the next slide. All right, one of our investments that I haven't actually talked about for a while. I can't remember when I last spoke about Intrepid, maybe early this year, I can't remember, but they did their maiden drilling. Okay, this drilling was at this Corral Copper property. It is one of a collection of properties they have. I'll show you a map in a minute. But in this first round of drilling, they managed to hit, the 3 headline holes here are all over 100 gram meter. Yes, they're copper gold. Okay, so I've converted and made these gold equivalent, gram meters. But each one of these puppies has hit bigly. Okay, 250 gram meter for the top one, to 135, and then 165. Okay, so that's a winner. In my book, when you hit 3 100 plus gram meter holes, especially in an early stage program, that's a discovery. So we know there was mineralization here, but this is definitive proof, and it's also very high quality data that they can use to build on now. Okay, go to the next slide. Okay, so Corral Copper is that little goldish colored circle way down there in the lower right. It's due east of Tombstone, Arizona. Now, everybody thinks Arizona. Okay, this must be a porphyry. Nope. This is actually a somewhat unique system in respect to the rest of the deposits, or I should say most of the deposits across Arizona. Yes, Arizona is well known for porphyries, but it also has another type of copper deposit that's lesser known. But Bisbee, you can see due south of Corral Copper, is an example. Bisbee is probably an IOCG, an iron oxide copper gold deposit. It is different. It's different age. It's different, formation, etc. I won't go into the weeds just now, but the point is Corral Copper is probably similar to Bisbee, and Bisbee was a very large deposit. It was a very large and high-grade deposit. It had very high-grade copper and gold, as well as some other metals. I believe it produced several million ounces, like 3 or 4 million ounces of gold, and several million tons of copper. Okay, Corral Copper looks like Bisbee to me. Go to the next slide. Here's the area they drilled. This is a trend. It's more of a linear trend, so it's not like a plug or an intrusion like you'd normally see with a porphyry. This is more structurally controlled. It's a shear zone. Think of it that way. So it's a linear belt, and they've named their targets very cleverly after Wyatt Earp. Anyway, I won't. OK Corral, right? So that's where the names come from. Look, they tested a number of these. There are historic holes there, but they tested a number of these, and they did get some really good results. But here's the thing. This drilling, as well as historic drilling, is very shallow. Go to the next slide. They barely skim the surface here. Okay, this is a vertical profile. Bisbee, we know, goes down hundreds and hundreds of meters. These guys are basically just testing the very nearest surface stuff. Okay, this is within 100 and 200 meters of surface, most of these holes that were released. Okay, these are kind of the blobs of mineralization that are showing up, at least with the current drilling. Are they open? Yes, probably. At depth, these things probably continue. That shear zone isn't going to just form a little narrow thing at surface. It's going to form a sheet-like thing that continues to depth. Okay, so these guys have definitely tagged into something that's interesting. Could it be another Bisbee? Perhaps. Okay, very good job, very good start. It's worth looking at, especially in the day and age when we know both copper and gold are going to do well. Let's go to the next slide. This is a core from that drilling they did. The picture over here on the left is a stick of basically solid chalcopyrite. Okay, if you know anything about porphyry deposits, there's little tiny veins that are all crisscrossing one another. This is not that. Okay, this is massive chalcopyrite, which is a copper sulfide mineral, and you can see it's way different. In terms of its geology, it's way different than a porphyry. Okay, and this image over here on the right similar. So the goldish color is chalcopyrite, big blobby stuff. And then that black stuff that's kind of net textures, like little, it almost looks like a zebra. Those are probably iron oxides mostly. That would be typical of an iron oxide system, okay, not IOCG. So that's what I look at and I think, yep. I think this is an IOCG. It looks a lot like Bisbee. I think they're onto something very interesting here. Okay, let's go to the next slide. Okay, Sitka announced the first drill results from this season's work. Okay, they released results for hole 157, I believe it is. Okay, and this is in an area, they stuck to the script. They drilled an area below where they had hole 47 last year, where they hit some of the first high grade seen on the property. Okay, now they got good numbers out of here. 191 meters, 1.16 gram. There are narrower high grade intervals within that, including 89 meters of 2 grams, 11 meters of 5.8 grams. But what's really important here, go to the next slide, is to understand what this means. Now, this is their cross section. Okay, we have 2 holes now. 47's up higher. 57, yes, it is 57, is down below, and you can see there's good continuity developing. Bear in mind the vertical scale on this thing. Okay, each one of those lines going up is 100 meters, right? So we're nearly 200 meters vertically below hole 47, and we're still seeing high grade down there. This is encouraging because you now start to see something that has a profile of maybe 400 or 500 meters this way, but it's also going to go in and out of the section. And what we know, this could be big. Now, I would love to say, this section does justice, but I had my guy build a 3D model. So now I can show you something even more that'll make you sit up and take note. All right, so we're gonna share screen. Yes, my helper here was in the hospital for the better part of a week and a half. Let me see, leapfrog viewer, where is it? There it is. But he's better now, thank God. And I now have ability to present to you 3D models again. Okay, so what we're going to do here is look at this discovery and look at the upside, which is really important. A lot of people email me and they say, well, is that result as much as you wanted, or blah, 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 blah. It's like, guys, you got to put it in context, okay? Put it in context of all the rest of the drilling that's been done here. And bear in mind, this is basically a brand new discovery, okay? This thing was discovered, 2 years ago? They've drilled, they actually put together a resource already, about 1.4 million ounces. But the area that they're drilling now is a new high-grade area, okay? So here we have our map that out of the news release. This is the topography. You can see it's a fairly mountainous terrain, okay? And look, I don't have the geology for the whole thing, but there's a lot of granite intrusions through this area that poke their nose up. And there's also a lot of placer gold down these creeks that is shedding off of this intrusive complex. But this is a classic reduced intrusive gold system. It is in the Yukon. It's very much like Snowline, and it's going to be big. Okay, and I'll show you why. Let's turn that off. So to see the drill holes, I basically turned the surface off here, and now I can flip this thing up and show you what's going on. Okay, first of all, there's quite a few drill holes here already. In fact, here at the Blackjack Zone, which is kind of this collection of drill holes, they actually had some high grades in here in the early days. They put a resource together around the shallow mineralization here, but last year they started drilling down in this area, okay? And in particular, drilled 47 right there, hole 47, which is that guy. And they hit a nice big whack of fairly high-grade mineralization right here. And what we offered is, this placement that we joined in. We decided to fund them so they could continue drilling in this area, okay? It's very important to follow up on a discovery like this. And what they do, they put in this hole right here. That is hole 57. Okay, now they also have this hole right there, that guy right there, which is hole 58. We are waiting on assays from that. They did see some visible gold in that, so I expect to see some pretty good numbers. But we do see a nice stout interval in here. of gold. And by the way, they had gold all the way up to the top. Okay, it's albeit low grade, but it's certainly within the realm of, we'll call it Fort Knox type grades, heap leach type grades. So I consider this a huge, huge win in terms of expanding the size of this thing. Now, if I turn it about like, let's turn our surface on here, just a minute. Oh, there we go. Going to turn it this way. Okay, if we turn it like so, we can see that the high grade is forming. There we go. Kind of a zone here. It's belling out. Okay, it's getting wider. All right. So it's, like here, it's wider than it is up here. Okay. So it is starting to balloon out. I do think that's important because I think we're at the tippy top of the system. So I think there could be something enormous down here. Yes, you got to put these things in context, guys. You can't just go, oh, that drill hole did this and that drill hole, whatever. Okay, no, you got to look at the whole picture. All right. So we got something that's starting to widen up down here. It's kind of evening out in terms of grade, but that's what we would expect, more consistent, say 1.x gram. And that's what snowline is. Okay, so there's little pops and whistles of high grade up here in the cupola, but it's starting to get fatter down there. Okay, so it'll be really interesting to see what comes back from this hole 58. And I don't know where the rest of the drill holes are. They haven't announced what other drilling they've done, but I think they're off to a great start. I think there could be something immense lurking down here. Okay, if I turn it this way, you can see it is wide open in this direction. People say, well, geez, that's underground. You know what? If you found about 2 or 3 million tons of 1.1 gram underground, you got to figure out how to block cave it. Okay. In fact, if anything, there's a lot of companies out there these days that would prefer to block cave something. So I don't see that as a dilemma at all. But where it gets really interesting now. Okay. This little area is called Saddle. Definitely have some good gold, albeit kind of spotty and pops and whistles here. But we do have gold popping up over here. Okay, look at the scale. The scale bar down here, as I zoom in and out, it changes. Okay, but you can freeze the frame and you can have a look at it. We're like 400 or 500 meters from this area known as Blackjack over here to Saddle. Do you think this gold connects with that? Yeah, I would say likely. How? We don't know, but I think it will. But then we have this area over here, which I believe is called Eiger, if I remember the name right. And this also has a bit of a resource put around it. Again, the assays are a little bit pops and whistles like spotty, which tells me they're probably high in the system. That's my guess. Okay, but there's some good numbers in there. Okay, but start to think in third dimension. You got gold here, 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 and we know this is driven by an intrusion. We know we're at the tippy top of the intrusion. Okay, imagine a mothership down here. Okay, that's basically generating all of this gold. Okay, this is the kind of target we're looking for. So do I get excited about the potential here at Sitka? Absolutely. And this data that comes back hole by hole is just very important in building the story. All right, I do think that we're going to find that all of these things connect, and there's something much bigger that's created the whole thing, and it's probably hiding down in this neighborhood down here. Okay, so there's that one. Let's see. Let's do stop sharing. Guys, if I blabber on, you got to tell me to stop. I notice it's after 1 too many Christmas. Okay, go to the next slide. Okay, I'll tell you what, since we're running so short on time, go. Core looks like tippy top of a big intrusion. I've made this point before. You listen to previous videos. This core tells me they're at the tippy top, and the grades in here are really strong. Okay, there's some nice individual assays in there. Go to the next slide. Okay, Altamira. I talked about Altamira. This is down in Brazil, but it is one of these reduced intrusions. And because my guy was sick for a couple of weeks and couldn't make the model, I had him make a model so I could show you. Even though this news is a little bit older, I'm going to go straight over and we're going to do screen share once again. And we're going to look at Altamira. And hopefully, if you guys can't see it, let me know. Okay.
We're good.
Okay, so first of all, we'll look straight down. You can see that there's this kind of bluish or greenish blue area. This is an area of subdued magnetism, probably from hydrothermal alteration. And then this white dashed line is basically outlining where they identify gold in soil anomalism. Most of the holes they drilled early were down here on the fringe. Okay, so people say, well, they didn't generate the values I want to see or whatever. Okay, yeah, again, you have to put it in context. They were down here in the fringe, but now they've drilled holes to the north, as I understand it. So I'm waiting to see what assays come back, further outboard up here in the core of this thing. But anyway, we're going to look at what they hit. Okay, so we're going to turn the surface off, and we're going to simply spin this thing around. You can see the grades over here on the right. Okay, there's some very long intervals. There is definitely a high grade core kind of showing up in this area. It's open at depth. It's kind of hard to understand, but basically it's open down dip. So I think there's something going on there. But I also think it's open up here to the north, and it's kind of hard for me to turn this around in a way you can see it. But I think it's open up in this area as well. So I'm really anxious to see what they come up with in that direction. This is all easily accessible within a potential open pit. It's starting to hold together. Like you're seeing a large volume of rock hold together right in here. Okay, lots more assays to come, especially to the north up here. And I think we got to sit tight, wait, see what they hit. I think there's going to be a lot more to this story. Okay, I realize I'm going way over, guys. Sorry. Okay, we're going to go. Novo is following up drilling in Nunyeri. And I'm director, chairman of Novo, so I want to disclose that. Anyway, we re-assayed a lot of the drilling that was done late last year using Crescat, so photon assay. We have some really stout intervals. They're nothing over 100 gram meter, but these were short holes. Okay, part of it is we simply didn't drill long enough to get the big meters. But we did a shallow RC program, and the initial RC program turned up some pretty good mineralization. Okay, now go to the next slide. We followed up with doing soils and other reconnaissance work across the bigger belt here. And everything that's in the red stipple outlines are areas that we've identified as targets that we can follow up. Okay, the drilling that I just showed you is entirely confined to that little tiny area up in the north, or to the upper right of this map. You can see a few little pokey dots with lines going off. Those are the drill holes that we had those assays from that I just showed you. All right. If you can imagine finding this over a broader area, there's actually a lot of volume here. This is about 2 kilometers field of view. That's a big target. Okay. So we're hopeful once we go back in there, we start to see, a lot more runs of 10, 20 meters of, 1.3, 1.5 gram type stuff over and over again. This could go from kind of a bit of a nebulous target, thinking it's small, to something that could be quite sizable with a bit of luck. Okay, so we're doing the next pass right now. Touch wood, we might find something bigger here. Let's go to the next slide. Okay, Inflection put out news this week that Anglo Gold Ashanti has decided to commit to the earn-in at Duck Creek. If you remember, Anglo Gold, by spending $10 million across all of these projects, they then have the right to now earn in on individual ones, and they've already elected not to say they won't elect on the other ones, but they've already decided to earn in on Duck Creek. So what does that mean? It means that Inflection doesn't have to raise money to go off and drill all of this stuff. Anglo Gold is going to be spending $7 million and then $20 million, and then to get to a PFS, probably like $200 million. Okay, like that's very expensive work. So basically, Anglo Gold's going to pay the bills for the time being, and they're going to do the work and hopefully make a big discovery. All right, go to the next slide. Okay, these are the highlights. I don't have time to read through every single one of these, but long story short, they are going to commit to drilling some deep holes down into the Duck Creek area, and they're going to test some of those anomalies. I think I talked about 1 or 2 weeks ago. They did some basically tomography is what it's called, to look at the subsurface and look for areas where there might be intrusions, and they defined some very discrete, high velocity, seismic velocity rocks at depth that they think are the intrusions. Okay, so touch wood, one of these 8 holes pokes into something like Acadia. Acadia is one of the biggest copper gold mines in the world, right? This is ripe country for finding something like that, and Anglo is going to pay the bills to get there. All right, and in the meantime, they're also paying a management fee. So basically, Inflection and their team is going to manage the work here. Anglo pays a 10% fee to the company to do that work, which means Inflection has the cash it needs. They don't have to go back to market. and that's a good outcome. A lot of people debate, is retaining a 25% interest, more valuable than trying to do it alone. Well, the markets have been pretty tough. I would say right now, yes, in my view, doing deals like this is absolutely essential to continue your exploration and create value. If copper was like $9 tomorrow and money was flowing out of everybody's faucet, then you can raise money to do that. We're not there yet, but this is a good outcome. And if they do make a big discovery, 25% of $1 zillion is a lot of money. Okay, you get my point. It's going to create a lot of value. Go to the next slide. This just shows you where Duck Creek is. So the dark red block there is the one that they've elected to earn in on. The others that are shaded in a bit darker red are the other earn-in targets that Anglo can opt in on. They haven't really got there yet. They focus most of the work at Duck Creek, but that's all right. They will. Okay, let's go to the next slide. Okay, Pacific Ridge had news out this week that they're going to do some work at this Chuchi copper gold project. This is the southernmost, well, not quite the southernmost. I guess Anjo is the southernmost. Anyway, over here on the right-hand side, you can see their claim block. That Chuchi is towards the southern edge of this map. Look, I'll be flat out. This isn't my favorite target in the world. Okay, I do like Cliola, and I think they need to do some more work there, and I hope they do. But I'll at least talk about Chuchi and what the plan is here. Now, they specifically state they found a 6-kilometer long copper gold porphyry trend. Okay, let's talk about it. Go to the next slide. All right, you can see it's a pretty big land position. Okay, this is probably 12 or 14 kilometers from east to west across this property. It's a big property. This data shows it's a little coarse grain, but it shows that there's definitely, I believe, in magnetics, there's a magnetic feature right there in the center, probably a porphyry or intrusive complex. And they believe they have multiple intrusive centers coming up. And you can see kind of a belt of little blobs there that are their interpreted porphyry centers. And I believe there's like 6 or 7 of the darn things scattered over about 6 kilometers through that core area. Okay, but let's talk a little bit more about this because there was historic work here. Go to the next slide. And you can see there were some relatively shallow holes drilled at this BP zone and this digger zone. I'll talk more about the results from that. But the work that Pacific Ridge has done here shows that there is a chargeable feature at depth, the bright pink thing, that really hasn't been tested yet. So they are committing to drilling some deeper holes, meaning 600-meter holes. I would like to see that at Cliole too. Hint, hint. But anyway, they're going to try to drill down into that chargeable feature and see if they can't find the mothership down there. Maybe it's there. So let's go to the next slide. Okay, now you can see some of the historic holes from that target, that image that I just showed you. So these are some of those shallow holes, up to maybe 200 or 300 meters depth that were up top. And there are some pretty decent numbers in here, guys. I'm not going to say it's not exactly what I want, but there's also some lower grade stuff, 0.2 copper and 0.1 gram gold. But if you kind of give it a fair look here, there are a number of holes here that would be over 100 gram meter. Okay, albeit probably in the 0.5 to 1 gram gold equivalent range. There's a few holes, notably hole 42 down there towards the bottom, where we do see bigger runs, like 50 meters at 2.23 grams. So there is at least some evidence you can create grade in this system. Let's hope they find it. I'd like to see them hit. Maybe that chargeable feature has a lot more of that higher grade stuff. Okay, but this is kind of like Cliole. Let's see what they turn up here. Let's go to the next slide. This is the Coho target. So this is one of the other blobs they have. Now they did grab some samples at surface across here. The average of all of those little polka dots above that drill hole, I think are 1% copper at 0.79 gram gold. This area didn't have historic drilling. So this is really going to be the first drill test, and they're going to poke a hole straight underneath that area. Maybe they get lucky. There's definitely a chargeable feature poking its nose up there. Maybe they find something interesting. Never know. But this will be the first test. Very anxious to see this drill. Let's go to the next slide. Okay, the last story of the week. This is the one that just complete headbang. Everybody's asked me, what's going on here? But Red Pine. So they brought in a new CEO. They also brought in, I think, a new board member here recently. And all of a sudden, we see news coming out of the company this week. Red Pine withdraws previously announced assay results for Wawa Gold Project, pending further review. Okay, do I have any answers? Absolutely not. I have no clue what's going on. If you read this news release, it's quite short. Don't really specify why they pulled it, what reasoning there is, other than to just tell investors that they should not, view the results that have been announced as, they got to take them with a grain of salt for now. Okay. So look, here's the thing about this property. What do we know? It's a property that's been around for a while. In other words, there's been a lot of companies or a lot of efforts to drill here, and they hit gold. Okay. So I don't think this is like telling us this is a scam like Kevin talked about an hour ago. This is something different. There's something, I would just be speculating, that they feel is not in line with standards, and they're going to rectify it. But I know that Michael is a pretty sharp cookie, and he will probably sort this out and restate the data or something at some point. We're just going to have to sit on our hands in the meantime until we find out what transpired here. I don't think, though, I mean, given there's so many historic holes going back for decades, I don't think, it's a total strange smash or something like that. There's something more that we just don't know yet. All right. That's it.
No salt.
No salt, hopefully.
Go ahead, Kevin.
That's all shaker. All right. Well, thanks. It's been, great, good stuff as always. Like we say in our disclosures and disclaimers at the beginning, we present the good news and the bad news as it's coming out, and it's kind of a bad news situation right now at Red Pine, but hopefully something that it's not as bad as it seems at the moment. Anyway, look, again, I encourage you to go check out our latest letter that we just put out. I had one final comment on the Apple earnings because Apple was up today, and there's some kind of myth that the earnings were good. I just want to clarify that their revenues were down 4% year over year. Their free cash flow was down almost 20% year over year, and earnings were basically flat year over year. So, on a real basis, negative. I mean, Apple, for like 5 of the last 6 quarters now has not been growing on the top line at all, and now the bottom line is not growing either. Of course, they just came out with this new Vision Pro, the Vision Pro goggles, and it was it's a metaverse kind of a play. That was all hyped up and supposed to be this great new product. They didn't even hardly talk about it on the conference call at all. I mean, there's huge disappointment there. So why is the stock up today? Stock was up today on hopes that they're gonna be announcing they said they're going to be announcing their AI strategy at the developer conference in June. And so you can listen to Dan Niles, who was talking about it on CNBC today, and he said flat out, I mean, the earnings, the revenues, the earnings, the free cash flow, this company has been disappointing persistently relative to the rest of the Mag 7, and yet people continue to buy it. They give Apple a free hall pass because there's always this hope that they're going to come out with a new product, and the stock tends to trade up around a new product cycle. So there's a hope that their AI strategy, which they've been behind, horribly behind on relative to the rest of the Magnificent Seven, is going to be this exciting new product to drive the next phase of growth. We're less enthusiastic about that. We think Apple is more of a signal of where we are in the macro climate today. That the company's not growing anymore, and we think that's a bigger sign of trouble for the overall economy that should be paid closer attention to. We're not quite as enthusiastic about the AI strategy because we think the AI today is much more about disruptive competition hitting the market, and much like the internet at the peak of the tech bubble in 2000, when all companies were spending so much money on capex, like they were back then at the peak of the cycle. It's usually a sign that you're at the peak of the cycle. Apple's expensing $100 billion of research expense, or cumulatively now, I guess over the last 3 years, they claim they've put $100 billion of expense into AI research. But are we going to see the return on this investment? Much like the tech bust in 01, 02, when that return fails to come through, that's when you get the downturn. That's when you see the recession. We think it's something more like that, getting ready to come about. So if you're interested in learning more, please do reach out to Merrick about our strategies, and he can tell you all about it. Tavi, any final comments?
No final comments. I agree. If somebody made a comment, Apple was up because of buyback shares, and and we knew that. It's interesting. 2014, by the way, we had a short oil play back in the days. If you recall, most of the companies at the time were doing higher buybacks and dividends than they actually made in free cash flow. This is the first quarter that if they do what they announce, and if they produce what it's expected for them to produce in terms of free cash flow, they're going to be doing more buybacks than cash flow, which is
they've announced more buybacks than their entire free cash flow expected for the whole year, more than they've ever produced in free cash flow for a whole year. So when you talk about capital allocation, and Warren Buffett, of course, has a big position in Apple, and some of his favorite CEOs that he admires and writes about and talks about, Henry Singleton from Teledyne, or Tom Murphy from Cap Cities ABC. And these guys were masters at capital allocation, and that's how he learned to build Berkshire Hathaway, and bought all these private companies where when the companies are successful, they're going to bring the cash flow to Warren Buffett, and he's going to get it reallocated. Well, in this, but what did Henry Singleton do when he was buying back his own stock? He bought back his stock when the stock was cheap, when it was trading at like 5 times earnings. Not when it's trading at 30 times free cash flow. And so I personally don't think Warren Buffett will be very happy with this quarter. You go read his shareholder letter. From a macro standpoint, he's the most bearish that he has ever been. And I think it was an absolutely terrible quarter. I think you're going to be able to buy Apple again 50% or more lower in the middle of the oncoming of the coming recession, maybe just in a few quarters from now. That's just my personal opinion, but it's based on some analysis and some comparables. Anyway, that's my take on the Apple quarter.
Sounds good. Great quarter, guys. All right.
And now one analyst on the conference call said great quarter, as they love to do to curry favor with the CEO. Not one great quarter coming out of this quarter, because it wasn't a great quarter. It was a lousy quarter. Anyway,
all right.
Good for me.
If you want to know more about Crescat and more about our funds, I would suggest you to speak with Merrick, and his phone number is right in the screen. There's also his email address. But we appreciate the audience, and we'll be back next week, hopefully. If everything goes in place, we should be back here. So if none of us get hit by the bus, we should be here. So, all right. Thanks, everybody. Take care.
Bye now.
See ya.